Well, let's get started. There's a lot to talk about. We'll be posting a research letter on Saturday is the plan. And I will be discussing a little bit of that and the thesis behind this idea of the letter in this for Saturday. So, there have been two macro developments, I would say, since 2020, since the pandemic of recession and the response from policymakers. One of them was the inflation resurgence. Now, I remember back in 2020, we were reading about the Spanish flu back in 1919 and how that response from policymakers back in those days actually caused inflation to get out of control. And then from there, we've had a view about that really started to materialize in 2021 regarding the issuances of treasuries and how that could potentially have an impact on the rise of interest rates. Those, to me, have been arguably the most important developments we've had since 2020. Then these two issues cause other things. Central banks have started to buy gold. We've had intensifying issues with deglobalization trends and others. We had a declining of equity markets in 2021, 2022. We had a resurgence as well of commodity prices and the Japanese yen collapse and all sorts of things. It begs the question, what is the next domino to fall? Now, I've started to research more about the British Empire, and during the war, Napoleonic Wars, when they were building up their own debt problem that they had at that time, it created inflation, obviously. So inflation was the first domino to fall as well. And the second domino to fall was the rise of interest rates. And at that time, one of the most important things that happened was that interest payment relative to GDP reached about 4%. And at that time, what they had to do was, it was too high. They were spending too much just to pay down their debt and not enough on the economy. So the economy began to suffer, and they had to restructure their debt. They had to run a primary budget surplus at that time and restructure the debt. And that was a time as well that there was a major devaluation of their currency. And so these are changes that happened back in the early 19th century. Which to me sort of point to the direction of where we're likely to go here. So let's go to the next slide. And to me, this is probably the most important slide of the whole presentation. It's looking at the public debt across different countries and the estimates by the OECD relative to GDP. So you're basically looking at how much interest payment relative to GDP in each of those countries. And you can see something that is remarkable is how much the US is ahead of any other country in the world. No other country is paying as much in interest payment relative to GDP than the US. You can see an example here of Japan. Now, Japan does have a larger debt imbalance in the US. And this is an unpopular view that I'm going to say right now. The U.S. debt problem is manageable, and it could even rise from here substantially. However, in order to get there, we need to adjust the interest policy. So the interest rate policy right now is inconsistent with this exponential growth that we're seeing in the debt problem. And so when you think about how currencies tend to trade, it's not about the imbalance that we have in the US. It's always a relative game, right? That's how currencies trade. If the US has to adjust the interest payment relative to its GDP to a much larger degree than other economies, that is likely to have an impact in FX markets. So I think we're on the cusp of one of the most transformative things or changes or developments in FX world that we've probably seen in a very long time. And I think that the resolution of this chart that you're looking at on the screen is that other currencies are likely to perform better than the dollar in the next, call it 3 to 5 years, in my view. So let's go to the next chart. Now you're seeing the U.S. alone. So I first showed the U.S. relative to other economies. Now let's look at the U.S. itself. Now, when we think about, have we seen one of the most aggressive hiking cycles in history? I think that's a good chart to actually point to and saying, yes, I mean, this has been completely inconsistent with the fiscal agenda. U.S. federal debt right now is somewhere close to 3.5 or so percent to GDP. Now we're looking at net interest, and this is then if you look at the CBO projection for 2034, which tends to be very tends to understate the problem most of the times. In fact, it doesn't assume any recessions in the next 10 years, which seems to me highly unlikely. It gets you about 4.1% of GDP. Look at this chart is going back centuries, 2.5 centuries, basically. And we've never seen this level of interest or cost to service the debt relative to GDP to the degree we're seeing today. Notice as well that back in 1940s and 1950s, we did see the U.S. debt imbalance be as severe as it is right now. But, what we saw during that time as well was that yield curve control and other measures actually helped the government to actually run a much lower percentage of interest payments relative to GDP. And so this was one way to allow the government to manage to have that imbalance that we had during that time. And I think we're going to go there again. Let's go to the next chart. What has been, one of the biggest phenomena that we've seen so far in equity markets and macro in general since the global financial crisis, arguably has been as well the outperformance of U.S. equities versus other places in the world. I was in a macro conference this week, and I asked the question, what do you think is the reason why we've had this? And a lot of people like to say that it has to do with the technology sector and all sorts of things. And I think that other economies arguably also solves a lot of those technological advancements, although the U.S. does carry most of those mega cap companies and large brands in the technology world certainly come from the U.S. But I would maybe point out to something that not a lot of people point out to, which is what I call here America's fiscal exceptionalism, which the only reason why the U.S. is able to run a much larger fiscal deficit than other economies is because it has the reserve currency status. The reserve currency status allow a country to be less disciplinary for longer. That's really what it does. And I fully understand that by being the reserve currency, you actually have to be running a current account deficit as well. Or I should say a twin deficit in a lot of cases. However, one thing is to run a deficit. The other thing is to run a double-digit deficit, in which I think that's the main problem here. But you can see at 8.1% or so, you can also run the primary budget deficit if you wanted to, and you're going to see something similar. So this chart, the first panel of this chart, is looking at the average fiscal deficit to GDP that we saw all the way back to the global financial crisis. To me, this is what it explains. And it begs the question, can the U.S. continue to have this type of imbalance moving forward? Now, I can create a scenario here, and I would say maybe go to the next chart real quick. And you can see here the trade balance. The trade balance has been, also another thing that adds to the problem, right? We've seen that the deficit's becoming more pronounced over the years, which is, this chart would be irrelevant if we're running a budget deficit at much lower levels. Now, considering we're running, 5, 6, 7% to GDP and how much we're in government spending, when you add another 4% of trade balance, well, that starts to become very, very relevant. And think about how much is our dependency on importing oil from the rest of the world. Despite the fact that we are the largest oil producer, we still rely on sour crude because we don't produce those in the U.S. Because of the infrastructure that we actually have for refining in the U.S. requires us to actually have to import a lot more than a lot of people would expect. And so those are changes that only add pressure to this, what we call the twin deficit, which is adding essentially the trade balance, which is the current account, plus the fiscal deficit. And that's what you get, this twin deficit issue, which to me is a structural problem that creates even further pressure on the dollar versus other currencies. But let's go to the next chart. Or next slide. How do you manage a debt problem? In my view, there's really three ways essentially that comes down to. One is austerity. Austerity by either lowering government spending or collecting more taxes. Those are basically the answers on the very first one. The second one would be through some sort of suppression of yield curve. Or suppression of yields in general. Yield curve control has been one of the measurements that we've seen. We're seeing Japan doing now. We saw that back in the 1940s. There was some signs of that as actually also during the British Empire in the 19th century. So there has been a history of types of yield curve controls. They all happen in different ways. And the third one, I think it's extremely radical. It tends to happen more at the end of a problem. Is that debt restructuring is when you really hit a wall of debt and you have to restructure the debt. And in some cases, it could be forgiveness of debt, which tends to absolutely kill the currency. Or it could be essentially just changing the duration of the debt. Back in the 19th century, that happened. It was basically what they did. It was they took on the debt and restructured that in a very, very long-term maturity and created a sinking fund that would essentially allow the government to have a fund to prove to investors that they would be more fiscal responsible. We could go there. Who knows? And nobody knows what the answer will be here. But if we want to continue to have all the, this legacy on the dollar and all sorts of things, we got to take care of this. This is becoming, when I show the first chart, initially, I think a lot of people would think, I've been trading currencies for a long time. This has never been a problem. I've never seen this becoming a problem. You're right. And, net interest payments relative to GDP, if you traded over the last 50 years or so, has never been a problem. But I just showed you a chart that we're all-time highs now on that measurement, higher than any other time in the last 2.5 centuries. And the same way, like other empires, the beginning of an end necessarily actually started with those issues, with net interest payments becoming really high relative to GDP. Now, I'm not here to say this is an extreme view that this is the end of the dollar or anything like that, although it's a possibility. This is a macro view of the next 3 to 5 years, irrespective of any political party and any political views, really. This is an imbalance that I'm not sure there's any other way to really fix the problem outside of those three options I'm giving or providing in this slide that you're looking at. So austerity, I think, will become a problem, or will become a measure as well to fix the problem at some point. But probably not the first one. We've got an AI revolution happening. We've got onshoring. We've got deglobalization, military spending. Boy, I mean, there's a lot of things that we probably need to spend capital on that, unfortunately, the agenda fiscally needs to be larger than historical standards. So what does it come down to? Are we going to see debt structuring? Probably not as well. I mean, I don't think that that's going to be the case anytime soon, unless we really hit a wall here, which I'm not sure that's really going to be the case. I think the yield suppression is a much more likely scenario in the near future. And that's why I'm giving a bigger, I'm emphasizing that one as what I think to be initially the first phase of dealing with the debt problem. And if you ask me, this mandate that the Fed, this obsession that the Federal Reserve has over inflation and over labor markets is likely to be changed either in a open way or in a very indirect way, and where the real goal or the real mandate of the Federal Reserve is actually making sure the government can pay its bills. And so yield curve control may become, some of the most important policies that we may see from the Fed in the next few years. Let's go to the next chart. And so it creates this idea, right? If the U.S. has to adjust its interest rate policies to become more consistent with the debt problem relative to every other country in the world today, because I just showed to you, no other country has interest payment on the debt as to the degree that we're seeing in the U.S. Well, then it begs the question: well, what does it do to the dollar? What does it do to other currencies versus the dollar? And if there's one chart, there are plenty of charts that I would point out to, but if there's one chart here that you should be paying attention to in terms of the currencies that have been moving is the British pound. It wasn't too long ago when the Bank of England suffered from an issue where basically they're doing their QT, their tightening of policies. At the same time, their government passed a tax cut from an unfunded liability issue. And guess what happened? The market got spooked, and we saw a surge in interest rates in the UK. And UK gilts actually collapsed on a sort of a short-term period. And the BOE had to kind of reverse their policy and start buying those instruments in order to suppress the yield and help the currency. So it wasn't too long ago that we saw a problem with the Bank of England. And despite all that, the British pound is breaking out relative to the dollar. Is that just the beginning? And I remember looking at interest rates. They look just like this. Back in 2021, I've looked at all these charts of interest rates, not just in the US. It was the case with the German bond yield. You can look at the French yield. You can look at I think the only exception really was the Japanese yen. But outside of that, even though the Japanese yen actually also moved, there was, if people remember, there was a cap on the 10-year yield that actually end up moving well above that cap later on. And I think that that's exactly the case here. And this is coming from a view of Crescent has always been very bullish on the dollar. This is a change of at least, I would say, our own macro opinion about what's likely to happen in the next 3 to 5 years. I think this is going to be a really important change here. Let's go to the next chart. Another thing that it may cause, as we see flows going out of the US dollar into other currencies, it actually makes me think about this chart. It's foreign holdings in US equities. Now, if we see that flows of dollars, and by the way, you would think that given the fact that we have interest rate differentials, in other words, the interest rate policy in the US is much more aggressive than other places in the world, you would think that the dollar would be surging right now. And if there's anything a macro trader should be paying attention to is when you see an asset class that should be moving up for whatever reason, there has been a tailwind, a macro tailwind in that asset, and that asset is actually neglecting to move higher in prices. And I think this is exactly what's going on with the dollar right now. And if we do see flows moving away from the dollar, this could have a lot of ramifications and implications in global assets. And I think this is one of them that could also, wouldn't surprise us because, we've been bearish in equities. And I think this could be what it could tip over a lot of things. And maybe that's the one too. So you're looking at the US allocation has been basically saturated. And we're at levels that we saw back in the tech bubble. Where is the money going to come from? It's a very good question, especially if the US at some point has to hit a wall and even have to run some austerity measures to cope with the debt problem. So let's go to the next chart. So now you're looking at a regime change. 2-year yields, they broke out of a very important resistance, as you can see there. That's what, to me, marked the inflation era. When I saw that, and I remember looking at this chart prior to breaking out, and a lot of people had very strong views about this, that we would not see the 2-year yield because we've seen too many times it bumping at that line. And this is going to be another one of those that we're going to see a major decline. And guess what? We did see a breakout. And now, in my view, after seeing folks go on from 7 interest rate cuts in the curve to now two interest rate cuts, I actually think there is a very strong possibility we could see 2 things: inflation reemerging even more, and number 2 is the actual multiple cuts in interest rates because of the debt problem. And that's what happened also in the 40s, right? Allowing inflation to run hotter than historical standards is how central banks and economies tend to deal with, very large debt imbalances. And I think the Fed and the US is likely to be dealing with this the same way. And so it wouldn't surprise me if we have a decline of 2-year yields to back to their to that resistance line that is likely to become a support, in my view, as we see things. And this is a big move, a 4.6, 4.5% on 2-year yield all the way back to 2%. That's a very, very large move that is definitely not priced into the curve at all. And so anyways, this is another way of thinking about those flows. But let's go to the next chart. Now you're looking at the 3 months versus a 10-year yield, with this one of our views as well, in terms of a way to trade or to think about where interest rates are likely to go, which is the steepener, the steepening of the yield curve. In other words, is the probability of the long end of the curve starting to rise more than the short end. We have a very strong view about this. We think that we're going to see another abrupt move of the steepening of the yield curve, which tends to be very recessionary too. If we go to the next chart, this is another measurement that we actually created this indicator. It's a percentage of yield curve inversions, which remains at about 76%, but we're seeing inversions going away every day. In other words, if you look at all possible spreads of the yield curve, we used to have close to over 90% of the yield curve was inverted, and there's 45 possible spreads in the treasury curve. And if you look at those 45, 90% of them were inverted. So right now we're about 75% or so. Can we see a return back to zero? Yeah, we've seen it many times in history. After major inversions, we tend to see the other side of that. We think we're going to see that again, and that tends to be very recessionary as well. And if you want to pay attention to the gold standard of recession indicators, that's in the screen right there, and that's a screaming recession ahead in our view. Let's go to the next chart. I'm almost done. Now, if you have a view on 2-year yields, if you think 2-year yields is likely to fall for all the reasons I just mentioned, mainly the interest debt payment relative to GDP, then you would suspect what would that cause? And usually what we tend to see is this relationship between gold and 2-year yields. When 2-year yields fall, we tend to see gold rising. And by the way, I want to give credits to Ronnie and the guys from Increment and AG, because although they didn't do this chart, they did something very similar that actually inspired me to go and create this chart. So I'm giving credits to them because I think that's the right thing to do. But I think this is an important sort of moment as well for gold, because seeing those changes on the dollar to me is what it takes gold to have its next leg up, and not only gold but other metals as well, which we've been very constructive in those and that asset class overall. Let's go to the next chart. I'm trying to go a little quicker now. So there's been a macro regime shift back in 2020 when policymakers, the way they responded towards the pandemic, and that created finally a break of a long-term declining trend of commodity prices. Where are we now? We've been consolidating on that trend. In our view, this is the beginning of a upper movement that is likely to take a full decade of, or a secular bullishness in or bull market in commodities, or a commodity super cycle, whatever you want to call. I think all those are appropriate ways to talk about the opportunity in this hard assets, but particularly in commodities. And we tend to like the metals a lot more, but really all sorts of commodities should, and in our view, are likely to benefit in this macro environment. Let's go to the next chart. And then you look at allocations. U.S. family offices barely own commodities. That's what makes something asymmetric, is when nobody owns it. And so seeing this is only adds to the thesis. Now I'm going to make the last point here, which I used in a chart, this chart for the prior presentation. If we go to the next one, you can see here something that I think it's somewhat bizarre, but also I think adds to the whole idea. Is really looking at the private fixed investment in the mining industry. Used to be about 17% of GDP back in the 60s, and now it's about 0.3%. I think this explains a lot why the mining industry has been underperforming. Is the lack of capital entering the space in a large way. And yes, there has been a lot of technological changes that have efficiently changed this industry, but that doesn't explain this huge shift from a sector, an industry that used to be so relevant, and now it's become basically completely ignored. In our view, metals, and I think one of the things that really answers in this chart potentially, and the reason why we've seen this declining trend is globalization. Is us depending more and more on imports of ore overall, and metals. And I believe that as these global deglobalization trends, so we see the break of that globalization trend in 2020, and now a total change of regime in terms of geopolitical risk. I think that mining could become a critical industry again, and if that's the case, capital needs to be returning to that industry in a very significant way. Now, am I saying we're going to go back to the 17%? Probably not. But certainly, in our view, 0.3% is also, too low, and so there's a lot of room for growth, and in this industry, and that's, I'm going to just repeat a phrase from Senzel. Great money is made where there's a true lack of capital and capital interest in an industry or in a company, and this to me is the definition of that idea right there. I think this is my last chart. But I just want to prove to that. I might have a chart of mining. Yeah. Notice yesterday, the gold prices were down about 2%, and mining stocks were down about 2% as well. Those are not usual trends. Pay attention to those things, because I remember presenting this maybe 2 weeks ago, showing a chart of gold from the 1980s to the early 2000s, and it was down about 70%. Imagine creating a segment and talking about why you thought gold prices would go up from there. And by the way, that was exactly the bottom of gold prices, went up from $200 to $300 all the way to what it is now, $2,400, $2,500. And so, can we see something like this in the mining industry? Those are the things that a lot of folks believe it's unthinkable. I do think that that's going to be the case. It's been one of the most unsupported historical views that the mining industry will not follow gold prices, and that's just not our view at all. We think ultimately gold prices do translate into better margins, and it ultimately translates into capital coming back to this industry. And notice what's happening with copper prices and copper miners. Copper miners are seeing inflows of capital. Yes, it's coming from the electrification and all sorts of things. But, in our view, that also will drive the openness to the overall industry that should at some point drive capital back into the mining space, especially in the gold and silver space as well.